Hello everyone, welcome back to Financial News and Channel 4. Today is September 13, 2021. My co-host Paul Munico from Ameriprise Financial is going to give us an update what took place in the marketplace last week, Paul, and then when you're finished, I will give the last minute this morning input that we got from Ameriprise.
Great, thanks Ron. Today I'm going to talk about the Social Security report that came out recently and try to answer some of the points that it brought up. So the number one question is, will Social Security benefits stop after the year 2033? One opinion is no. Last week, the trustees of Social Security and the Medicare trust funds issued their annual report on the current and projected funding status of the programs. Now, this year's report showed that Social Security Trust Fund for old age and survivors insurance would deplete its trust funds by the year 2033. That is a year earlier than previously projected. Now, the depletion date for the separate Social Security Disability Insurance Trust Fund was adjusted to 2057. Current payroll taxes dedicated to funding Social Security, Federal Insurance Contributions Act, or FICA, they generate less tax revenue than is being paid out to its beneficiaries. The difference is funded with the excess reserves built up in the trust funds during the period that payroll tax revenues into the program exceeded the payments to beneficiaries, a period largely spanning from the mid-1980s through about 2010. So, what happens in the years 2033 and beyond? Well, when the trust fund reserves are depleted, that's technically referred to as being insolvent, benefits will still be paid, but at a reduced rate. Now, under current law, when the trust funds are depleted, payments going out the door to beneficiaries would need to equal the revenue coming in the door via those payroll taxes. Actuaries for the trust fund estimate that payments would automatically be reduced to 76% of their value. In other words, a 24% haircut to those OASI benefits across the board. Now, such a scenario, however, is very unlikely to happen in our view. Social Security constantly ranks as one of, if not the, most favored of all government programs. It would essentially be political suicide for any elected official to allow insolvency to be reached. Second, we've been here before. In the early 1980s, a Time magazine article said that the trust funds were likely 6 months away from insolvency before a bipartisan agreement was reached to rectify the problem. Most people are likely unaware of the relatively modest actuarial changes that were implemented under the adjustments made at that time. However, those adjustments enabled the OSAI program to see revenues exceeded benefit outflows until approximately the year 2010. That according to the program administrators. Now, ultimately, we believe elected officials have ample actuarial adjustment levers available, including a potential one-time infusion to the trust funds to provide more time if necessary, although we do not believe that will be necessary, to extend the program's full benefit lifespan at least until another future date. Now, such adjustments offered little to no material impact on economic conditions in the 1980s, and we believe prospective solutions would offer little negative economic impact in the current situation as well.
Paul, that's bad news when you think about it.
Well, it's bad news depending on how you look at it. So we've been talking about the potential for Social Security to be insolvent just by this reporting as back as far as that is the 1980s. It's consistently paid out. It's one viewpoint that we went over today, that there are actuarial changes that can be made,
Yes.
cash infusions, so there are ways to save it.
Yeah. I just can't believe that it could be going into an insolvency.
We've talked about this before in prior years too. I mean, it's always on the forefront because so many Americans rely on Social Security. That's why any negative impact to it seems unlikely just because so many Americans do rely on it.
Yeah.
But I don't control it. I don't know what will happen, but we've got, at least according to this report, some years to try and figure it out.
Talk about political suicide. Whew.
Yeah.
Okay, well, Ameriprise Financial gave us a report as of this morning with the information taking place this morning. The U.S. stock index futures are higher as the S&P 500 looks to stamp up a 5-day losing streak. Any comment, Paul?
No, I mean, I'm surprised we had that 5-day losing streak because typically in the recent past we'd be down a few days and then we'd see buyers come in.
Yeah.
Looks like early points today may reverse that trend, like you just said. We may have a positive day, but we'll have to wait and see.
And the yield on the 10-year Treasury is lower to near 1.32% ahead of multiple key inflation readings this week.
Yeah, inflation has been on the increase, which does concern the bond market, and we're seeing it react in accordance to that.
Right. And Hong Kong's Hang Seng Index fell 1.5% overnight on continued Chinese regulatory concerns. And they're making lots of changes, and I'm seeing impacts.
There's a lot going on over
Yeah,
there.
yeah,
And
there
you're
sure
right,
is.
we're seeing the impacts of some of those changes.
And shares of Alibaba are lower after Financial Times reported the Chinese government wants to break up the firm's financial arm, according to Alipay.
Again, a lot going on over in China,
Yep.
and that's
It's all part of it.
All part of it, correct.
But there is some good news. The index year-to-date percentages are as follows. S&P 500 plus 19%, Dow Jones a plus 16%, and NASDAQ a plus 14%.
We've been saying this every week, but
Every
those are
week.
staggering numbers. I mean, those are really good returns
Really solid.
For the major indices so far this year, and let's just hope we can keep it going.
Well, stay with us. Thank you, Paul, for that information. And we will be going to our show called Your Money. Paul usually has an excellent topic on it. Stay with us. We'll be right back. And we're back with Your Money. Thank you for staying with us. Paul is going to be talking about if your portfolio has room for both active and passive investments. Paul, I'm going to let you take it from there.
Thanks, Ron. And that's exactly the topic. Does your portfolio has room for both these different styles of investing? So let's dive into it and see if it makes sense. Investors today live in an era that's offering unprecedented global investment choices in both active and passive vehicles. Investments in each category have opportunities and challenges for investors to consider when crafting an optimal financial strategy. So with so many choices at your fingertips, how can you best capitalize on what the markets have to offer? You know, there's no right or wrong answer for everyone, but in many cases, it may make sense to use both styles, active and passive investments, to effectively build and manage a diversified portfolio. So let's define active and passive investing. Active investing is an approach that seeks to capitalize on inefficiencies in the market by identifying individual securities that don't currently appear to be priced based on their true underlying value. Success using this approach generally requires in-depth research by analysts and by knowledgeable investment professionals. Many traditional mutual funds fall into this category. Active fund managers who oversee these funds seek to generate returns that outperform a benchmark or a specific measure of market performance, such as the S&P 500 index. They make investment decisions based on a defined approach or strategy. Now, on the other hand, passive investing is an approach that seeks to match the performance or a specific benchmark or a segment of the market. So many passive investors choose, for example, to put their money to work in an index fund that invests in a broad segment of the market. Perhaps the most common passive investments are funds that track the performance of the S&P 500 index. That's an unmanaged index of large capitalization U.S. stocks. The premise to own a broad cross-section of the market or of a segment of the market rather than trying to identify specific securities that may outperform a benchmark or segment of the market. Now, it's worth noting that there are increasingly more investment options offering a middle ground between active and passive strategies called strategic or smart beta. Now, this investment strategy is intended to combine the transparency, consistency, and cost efficiency of passive investing with the investment insights found in active management. Considerations for each approach: there are benefits and shortcomings to each approach. Actively managed investment strategies offer the opportunity for outperformance versus a specific segment of the market, but they can also take steps to defend against the impact of down markets that inevitably occur from time to time, often by avoiding individual securities or sectors that have challenges. To accommodate the research and expertise involved, actively managed investments typically come with higher expenses, which do detract from the net returns they generate. Also, because they're using a selective approach to investing, there are times when they will choose to invest in securities that don't perform to expectations and perhaps miss out on the full benefit of broader upward trends in the market. Now, a key benefit of passive investing is that fees tend to be lower than other investment strategies. They also tend to be tax efficient because trading is minimized in the fund as it continues to track an index over the long term. A downside to passive funds is that by simply investing in a benchmark, an investor forgoes the opportunity to outperform that index. This means returns tend to match those of the market, minus any fees. Also, in volatile periods or when markets trend down, index fund investors will see their investments follow a similar path. A case for both strategies is one approach, the best approach for your portfolio. That reality for many investors is that a combined approach may be an effective solution. Investors should pay close attention to factors that can affect their investment results, including fees, different sources of potential investment return, and the benefits of a diversified portfolio. You may determine that part of your portfolio should generally track with the market. If that's the case, a passive fund may make sense. At the same time, you may want to take advantage of specific opportunities and segments of the market where the selectivity may help you reach your goals. If so, active strategies may offer the best path to success. The good news is that you have a tremendous opportunity to effectively diversify and tailor your portfolio to help you achieve long-term goals. As always, a financial advisor can work with you to determine what approach and investments work best given your financial goals, investment time horizon, and your risk profile.
Paul, to use your guidance on this active and passive investments, for you to really fine-tune your portfolio and reach your objectives, you need a financial advisor. I don't see how anyone can possibly have the resources to determine which way to go and when.
There's two different styles, and you're right. Which way suits you best is personal. It's something you can't just read on the internet necessarily and get an
Right.
answer to. And working with someone in this area can be of great benefit to the individual. As you think about it, a lot of people consult a travel agent for vacation plans. They consult an insurance agent for insurance needs. Your financial life, I mean, that everything you work and save for is in that financial plan. Working with a professional may be of benefit to you to do so.
Long-term wise, for sure.
Yep.
For sure. Paul, thank you for the topic. For Paul Munical with Ameriprise Financial and myself, Ron Jankowski with Channel 4 in Pale Sites, we wish you good investment day.